Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates. Welcome to Charts and Chat for April 23rd of 2023. Please see our disclaimer for important information. Starting out the chart pack this week, we're going to first begin with the credit default swap for ensuring or hedging against the risk of default for the U.S. Treasury. Here we have the 1-year U.S. Treasury credit default swaps. You can see this time series goes back to 2007, so obviously the global financial crisis is captured here. You can see these various peaks of kind of a crisis of confidence, if you will. We got debt ceiling crisis and the fiscal cliff in the last decade, and of course, we've eclipsed those levels now too. So there's this brinksmanship that is, I think, almost assuredly pure politics here. Neither the Democrats nor the Republicans are ready to blink, but tax receipts thus far in the tax collection season have been below expectations. So that's driving up the anxiety a little bit about the federal government, quote unquote, running out of money before we can have some resolution on this. But I'm fairly certain that it will, but it's going to create a little bit more anxiety, at least in the fixed income markets. Really hasn't manifested itself in the equity markets just yet. Spent a lot of time lately talking about the money supply, and you can see this chart here from the Wall Street Journal, both M1 money supply as well as M2, which is more, it's a broader definition of money supply, and you can see that those are both tracking negative, and they've been decelerating for quite some time because of the interest rates, but not necessarily started by that. So we know that there's been quantitative tightening to a large degree, with the exception of what happened around the Silicon Valley Bank issue in March. But money supply has been contracting for a while, and has certainly been in deceleration longer than that. So this is something that's going to help us get that inflation under control. Quick check-in on the Fed discount window and bank term funding program numbers. You can see here, this is a combined chart with both of those programs. And obviously you can see Silicon Valley Bank, everything spiked up, went down for several consecutive weeks. And then very interestingly enough, 4 straight weeks going down, but then we had a slight uptick last week. So we'll continue to monitor that. Nothing too earth-shattering, but we had expected to see that continue to decline. This is a quick look at the implied Fed funds rate at the upcoming May meeting for the Federal Open Market Committee. You can see that those numbers are meandering back a little bit higher. So we are now officially back up above 5%. There was some talk around the Silicon Valley Bank and the banking issue last month about that the Fed might be pivoting and beginning to lower rates. Well, that seems to be going by the wayside now. There's a fairly strong consensus that the Fed's going to raise another 25 basis points and then hit the pause button for a while. And you can see that whipsaw here going from 5.4% down to 4.75% in fairly short order around that Silicon Valley default, but then obviously moving back higher here. Note from Liz Ann Saunders on the Empire Manufacturing Index, and we've got a Philly Fed, and then we've got the Empire Manufacturing, seem to be perhaps a little bit at odds with each other. We've got the manufacturing survey for employees, maybe a slight uptick, but it's still showing negative. But we did have an odd surge in the overall Empire Manufacturing Index last month, as Liz Ann mentions here. We had a rise in new orders, and we also had a rise in shipments, which is obviously good to hear. But there seems to be still data like this that kind of belies kind of the broader subset of data, which kind of tells us that we're heading towards that recession. This is I think part of the reason why I think some areas of the market are still a little bit confused. We still have, as we'll see in a few moments here, a deeply inverted yield curve, almost uncannily inverted at this point, very much signaling recession. And then you have this, which is it's tepid. It's not great. It's not really great news, but it's obviously well above expectations. Here's some data from Philly Fed. So you can see directionally that these are all moving in the same way. We'll just kind of start and kind of work our way clockwise from the top here. We have the new order index for Philly Fed. Latest reading confirms a trend that we've been watching for some time, definitely in the negative. So we see that contraction, at least in the Philadelphia Federal Reserve region. And then lower right here, we've got CapEx plans. So obviously, if your new orders are trailing off, your capital spending programs are likely being curtailed at this moment. And then over here on the lower left, you have the all-in index, and you can see that these numbers are coming in well below expectations. Survey was looking for a pretty weak number, but what we got was actually a lot lower than that. And what's important on this particular chart in the lower left is that, again, a time series that gives us some points of reflection here, going back to 2005, so encompasses the global financial crisis, which is obviously something that did not happen overnight. You can see that dip there, and we're almost to those levels. So, when you look at the magnitude of the drop in the Philly Fed, and then obviously juxtapose that against what we just saw in the Empire State, it's telling you that some areas of the country are performing a little bit better than others. But I think what it's telling you is that the overall backdrop is really looking to weaken here. Here we've got the Conference Board of the leading U.S. economic indicators. And this time series goes back quite a ways, back into, essentially 1960. And so you can see these red shaded areas, those being recessions, and you can see the activity of the LEI ahead of those. And it really is what it purports to be, and it is a leading indicator for where we're heading, and that indicator is clearly down. In fact, levels that we're seeing now at negative 7.8 on a year-over-year basis are very confirmational in terms of that likely trend that we're looking at here over the coming months. Here's a quick look at the contributors to LEI. Again, a leading economic indicator. And there's multiple components here, and you see them broken out here. And these are, each, indicators in their own right, but then collectively, and you see the weightings there in parentheses, what they represent. And all these areas, are really looking pretty weak. And with rare exception, they're all negative too. So obviously, non-discretionary capital goods, aircraft, they're slightly up about 0.02% And then you also have consumer good orders that are slightly positive, but again, very tepid. Then building permits, which we know is fairly weak. Commercial sector is looking fairly exposed right now in that regard. Consumer expectations are also weak. ISM new orders are particularly weak. We just saw that in the Philly Fed data. Here's the annual growth rate of LEI, and this is overlaid with the year-over-year change in real GDP. And as you would expect, there is a pretty decent directional relationship. It's not a one-for-one. I'd say the correlation here, if I had to guess, is somewhere around about a 0.55, 0.6. It's clearly positive, but the LEI is not meant to mimic GDP. It's meant to give you inflection points for you to understand. And so when LEI goes down in the blue line here, it does foreshadow recession. And sometimes you get kind of false positives when the LEI goes down, but not very much as it did in the last decade. We got a couple of false positives, but you see the magnitude of the drop here lately. And so I'm showing you several of these LEI charts because LEI does a really good job of giving us some advance indication here. And you see, directionally, GDP usually catches up to where the LEI is going. And in fact, it is moving the same way right now But again, I just call your attention to the magnitude of the drop. And also, let's reflect back on the global financial crisis. You can see here the change in the LAI really began to decelerate, honestly, in 2004, 2005. Market wasn't paying any attention to that. We got into '06 and '07, kind of plateau or kind of flattened out a little bit, and then took a sharp drop before we even hit the Bear Stearns and Lehman Brothers. I mean, it was already moving down. And again, if you're a student of the market and you've been through a few rodeos, this is the kind of stuff that you really want to pay attention to. Here's a quick look at real estate, commercial building activity, which is something I mentioned to you previously. You've got the LEI in the red here. Again, another LEI chart. But this is showing us on an 18-month lead, where we think commercial building activity is going to go. And notwithstanding all of these very valid arguments about the future of office, et cetera, this is a very inherently cyclical part of the economy. And you would certainly expect it to roll over when you see the LEI begin to roll over. Again, LEI like new orders, factory goods, factory shipments, those types of things, when they get weak, commercial building goes down because capital spending is going down. CEO surveys are beginning to turn. And so you just know at one point that this is going to change, and you see the very tight relationship here. This is actually a much tighter correlation than the one that we saw with LEI and GDP. Truck tonnage, as you can see here, is heading lower. It was down about 5.4% in the last reading. You can see that little tail down. So we're at levels that we saw back in 2021, and it looks like we may eclipse those and head back somewhere, not quite, but perhaps a little closer to where we saw in the economic shutdown in terms of truck tonnage. And as you might expect, rates correspondingly, freight rates are coming down as well. Look at the consumer perception of price increases. This is pretty interesting. I came across this in some research that I was looking at over the week. And again, it's a consumer survey. You can see here the source of SurveyMonkey, B of A Global Research, and 1,000 respondents. So, not an enormous sample size, but, they gave the same survey at two different points, and you can see the change is actually positive for some areas like grocery store prices. The perception that those prices are going up has intensified. Restaurants, bars, apparel, takeout and food away from home, vacation and travel, even a slight uptick in healthcare and home improvement, if you can imagine that. This is again the perception on the part of the consumer that these prices are still high. Here's multifamily units under construction. We know that residential building overall is a little bit sluggish. Home builder surveys are a little bit down right now, although they're not in terrible areas. I should say, a terrible area, but they're just weak, and you'd expect them to be weak. However, on the residential side, you do have more optimism because there is a supply and demand imbalance. And we had a chart in the chart pack last week that really spoke to that. And it's kind of like a secular dislocation now because of the chronic underbuilding that we saw over the last decade. And new household formation is outpacing the ability for builders to catch up. So what are they doing instead? Right now, they're building multifamily, which in the technical investor parlance is actually commercial construction. And you see a lot of permits being let for multifamily. Obviously, it's a very dense product that you can solve ostensibly more problems in areas that are fit for this type of product. You can solve more, housing problems. It's ultimately not going to move the needle, but as you can see here, whereas we've seen a rather sluggish progression in single-family residential construction, the multifamily side has really blossomed as of late. look at areas of the market here that are priced for a recession. This is from Bloomberg, and this is based on kind of anecdotal data about pricing and certain fundamental factors and the timing ahead of recessions and things like that. So clearly on the right-hand side, the yield curve is screaming at us that a recession is on our doorstep. You've got the MSCI ACWI, which is basically the international all-world index, and that is telling you that we're heading into a likely recession, a global profits recession. You got the S&P not too far off that, and then earnings, and then high yield credit of all of the areas of the market that I think should be alongside the yield curve, just screaming at a recession, but we haven't seen it yet, is high yield credit. It's actually very surprising to me how low a probability it's being priced in right now. Here's a quick chart from Charlie Bolello looking at the 3-month Treasury yield minus the 1-month Treasury yield. And as you can imagine, you see this flat line and all these little squiggly marks around the 0 point. The 1 and the 3-month are usually really right on top of each other. And in this case, just like we saw in the credit default swaps for 1-year treasuries going through the moon right now, you're seeing this huge dislocation in short-term yields right now. And you've got, a spread between those that, as of this chart, which was April 22nd, was almost 2 full percentage points, which is something you almost never, ever see. This is an extremely unusual environment. Here is a yield curve from our friends at Fidelity. You can see here the overlaid, you got the 10 to 3-month maturity curve here, and kind of the orange line, the darker line represents the 10-year to 2-year spread, the difference between the 10-year Treasury and the 2-year. And you can imagine that, those should have a positive relationship, and they certainly do. You can see that those yields are now moving negative and continuing to drive negative. You can see those are well below the 0 line. So we know that the yield curve has been getting more negative as of late. And down below, you see in the pink bars there, you've got the New York Fed recession probability now peaking at 57%. So it's giving us a fairly strong signal now for recession in the coming really 3 to 4 to 5 months here. Percent of yield curve inverted has moved off of its peak, but it's still pretty high. You can see that number now is in the low to mid 70s. And you can see where it has spiked previously, and those shaded bars where it has spiked, you can see very clearly, do tend to presage a recessionary period. You can see that most of the time, when you have these spikes in the percent of the yield curve inverted, you can see here that it happens on the eve of a recession. So again, this whole notion that's building for us and that we're going to get this recession. I think we can manage through it because labor is still very strong. And as we saw in the difference between the Empire State and the Philly Fed, that there are pockets of the economy that are doing okay. Incomes are high, bank balance sheets, with the exception of those who have purposely neglected to manage rising rates, are actually in really good shape. The money center banks are rock solid. These were the ones in global financial crisis that had to be deemed too big to fail. We have a lot of these support pillars in place to help maybe shock absorb the recession when it does come. Here is something that I thought was pretty interesting, and basically, we have not had a new low in the market for 6 months, and so this chart is kind of a diffusion chart trading days past the last new major low. And so the fact that we've gone this long without a new low in the S&P is actually pretty outstanding. And you can see that these outcomes, looking back on this, would tend to favor an uptick in the market. Now, we know that profits are slowing down, margins are coming in, and estimates are sliding a little bit. And I think CEOs are being cautious, but there is a case to be made here that over the next 6 months, because we have not seen that low, that new replacement low, if you will, that does tend to support some stock growth between now and what in this case will be really the kind of the first month of the fourth quarter. Another something that I thought was interesting is this chart. We have been monitoring this. Interestingly enough, as it relates to volatility, it's odd now that we are taking a downtick here in the average holding period for stocks for the average individual investor. And you go back to the wartime period here and the aftermath and the Great Society and whatnot. People tended to hold on to stocks for a long time. Now, some of this had to do with the fact that they had defined benefit pension plans and were getting company stock as well, and they would just tend to hold on to that for a long time. Now we don't necessarily have as many of those programs in place, and there's a lot more mobility in the labor force, so people tend not to stay with their employer nearly as long as they used to. But even still, even as the individual investor has come to own more stocks in general, they are tending to be more traders. And so what this contributes to, if you think about this kind of holistically, is you get a lot of individual investors that don't necessarily have the best knowledge or insight or have done their research on a stock, trading on some type of feeling, gut, innuendo, what have you, and they're not holding on to it because they're trying to turn those into gains. Not that they're necessarily day traders, but they're just clearly not holding on to them. And I think this does create, in some respects, some opportunities for long-term investors who are doing their research, but also what it is doing is potentially contributing a little bit more to volatility than would have been the case, say, 5-7 years ago. Here is the S&P 500 chart. This is a technical chart, so you've got both the what here is the 40-day and the 200-day moving averages. I tend to look at the 50 and 200, but this will most certainly do. You can see here the blue line represents the shorter 40-day, and then the red line represents the longer term moving average. And you can see, from that standpoint, we have held resistance on this index, and we've kind of bounced off of it, even though we've been, doing it in a very, unremarkable way. But technically, this is strong, and we punch back above that short-term indicator, and if we can keep that short-term moving average above the long-term moving average, that would be a bullish signal for the equity markets. And here we have the S&P 500 in the blue line up above. Below is the percentage of index members with prices above their 50-day moving average. And so we just saw and discussed in the prior chart where the importance of staying above those moving averages and showing kind of positive technical momentum is something that is certainly worth tracking and worth keeping tabs on here. And so we talked about the lack of participation in the broader updraft in the market so far this year. And what that means is we've had most of the movement in the index really be attributable to a relative handful of very large cap stocks that are obviously very influential to the index because the index is market cap weighted. And but you haven't had broad participation. Now that is changing, and you can see that in the amber line in some of these latest readings that we're back up to this midpoint of 55%. And so it tells us that we're getting greater percentage or participation across the board, and which is healthy from a technical standpoint. And obviously, if you're expecting the market to go higher, you certainly want there to be strong breadth to where it's well supported by all the constituents in the index. Not to throw cold water on the last slide, but this is, I think, the reality of the situation here in the broader sense. You've got profit margins, which we know are coming down, both the operating and net profit lines. You see here this great work from BCA to show us these trend lines, and so this is really the issue that the market's grappling with right now. So you have this chart. You have a deceleration in earnings. You have earnings that are beginning to come in here for the first quarter that are maybe a little bit better than expected. The beat rates aren't nearly as strong as they were in over longer periods of time, and we know that those beat rates coming out of the fourth quarter were a little bit weak too. So but the market anticipates that very well, and they say, well, listen, stocks can still do okay, and that's a very loosely held term because when you're talking about pre-recessionary markets, okay is just like essentially kind of flatlining, which I think, as we saw on that technical chart, that we've managed to stay above those moving averages, but it's been fairly unremarkable. We're oscillating around a tight band, and we're not really showing a lot of conviction, and volatility has really dropped off here, especially after the calming effect of what the regulators did in the wake of Silicon Valley to kind of calm down those fears. There's a chart on existing home sales. We know that they've been weak. We talked about that. Builder surveys still very sluggish. You can see this number at 4.4 million, how it relates to prior cycles. Obviously, the global financial crisis was a fairly strong dislocation, and so this is clearly an issue. There's a shortage of housing, but this is existing home sales. These are sluggish. There's still an affordability issue. Mortgage rates are kind of hovering in the 6.2 to 6.4% range on a national basis, and the market is just very tough right now. There's the home sales year-over-year change, and you can see that is still in a very deeply negative territory. And right now, the latest reading is negative 22% year over year. Here's the median existing home price, down 0.9%. So this is a trend that's been kind of forming for a little bit of time now as interest rates have moved higher. And we finally had that popping of that bubble. And we do see a lot of major metro areas, and particularly here in the Austin, Central Texas area, a lot of the appraisals for property tax are coming in right about now. And I think a lot of folks are seeing those decreases in the perceived and assessed market value of their properties going down. Deposits at small commercial banks are also going down. That is a trend, obviously, started by Silicon Valley. And you can see here it has accelerated. This is, less I think, an indictment on maybe the security per se of the banking sector, but rather a desire and an awakening on part of depositors that they can get better yields if they shop their business. And there's a lot of disintermediation going on at these small commercial banks. Money's being taken out. I think these lenders or these deposit institutions are having to become a lot more aggressive on checkable deposit rates, and a lot of people are also offering teaser rates on CDs to try to get deposits in the door. But what's interesting is we're also seeing a decline in the money market mutual fund deposits as well. So there's a lot of mobility of deposits right now. A lot of people looking at relationships and trying to find the highest and best place to park their cash right now. Here we see commercial industrial loans, C&I loans, trailing off as you would expect. 2023 thus far has been fairly sluggish, and we're back to levels that we saw about October, November last year. Very much in line with what we'd expect. And we look here at the job openings rate, and this really speaks to the strength of the labor market right now. This is a BCA. Bank Credit Analyst is absolutely one of the best shops out there, and this is such a telling chart. You can see, in the green line, a deviation of job openings from the cycle high. So when you get into recessionary periods, I mean, those tend to really extend out. You can see that very clearly going back to really the 1950s on this, and this is such a strong and confirming signal. And then conversely, you see the deviation in that darker line up above the midpoint of unemployment from cycle low, and you can see the very apparent lack of response in the unemployment rate to the change and the decline in job openings. That's something that, as you can clearly see here, is something that almost never happens, but it's going on right now. So we still haven't seen the response in the unemployment rate that we would have expected. And that's not to say that we're not going to see it. I think it's just saying that we haven't seen it yet. And here we have the foreign-born labor force in the peak working years. You can see how that's moved higher. It dipped during the pandemic. Obviously labor mobility was very challenged because nobody could go anywhere. And then so when the economy opened up, we began to see a real kind of change in this factor. And whereas it had been moving down over the months leading up to the pandemic, you can see it really spiking now. And so this is also one of those confounding points within the labor market that you do have a large number of foreign-born workers that are in our markets now and creating the supply of labor, which, again, this hasn't translated into higher unemployment yet. There's still, quit rates are rolling over, but there is, at least 1.5 jobs for every unemployed worker, and now you've got the foreign-born labor force perking up. So it's creating some very interesting and somewhat unusual cross currents, as we just saw in that last chart with the Bank Credit Analyst. So obviously we'll continue to watch this for the time being. We're going to close on the last two charts here with some data on China. So China has reopened. You can see here very clearly the first quarter GDP in China was up 4.5%. Obviously, some of the best growth that we're seeing across the globe. This is helpful because China is a very important economy. It's the second largest to the U.S. And so when China does well, that obviously helps emerging markets. It helps to buoy the overall global economy to some extent. There's a lot of consumption here that is happening on the part of Chinese citizens now that they're out. They're buying stuff. And so that's creating a somewhat favorable circumstance in China right now. And obviously this is likely to be a trend that kind of falls below their prior levels. But at 4.5%, they're definitely going to be leading a lot of countries in growth this year. And our last chart of the day is just this chart here showing the annual population change for China and India. China's in the red. You can see this is a really significant long-term problem. And I've read a lot about this. Peter Zion has written a lot about this. George Friedman, Geopolitical Futures, has written on this. There's been some pundits read several books on this, budding, Cold War between China and the U.S. And, from a demographic side, you can see that they're in a real pickle. And Oddly enough, they're on a 100-year plan from the date of the Chinese Revolution, which the end of this chart on the far right actually puts us to that terminus on that 100-year plan. And so it's real interesting to see here that demographically, China's in a real deep pickle now. The blue represents India, and what's interesting here, the article in the journal this past week said by mid-year, India will have more people than China. And even though the rate of growth in India's population is decelerating, you still clearly see here that it is expected to be positive, whereas China is shrinking its workforce. And when you think kind of on a long-term basis about the implications of a shrinking workforce and a real prohibition or aversion to immigration into your country, and when you're also talking about that being the governing body to that country being a very autocratic and insular government, then I think that leads you to some conclusions of Chinese, their aspirations for global supremacy coming into question here in the coming decades. All we have this week. I hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.